All right, we're here. All right, WeChat HQ fam, Cash here. I'm here with Brad again to talk about the top 3 stocks he's watching. So, Brad from Own the Chaos, the CEO of WeTrade HQ. We're going to talk about what you're looking at. How you feeling, Brad?
Feeling good, man. What's going on?
Nothing much, man. What are you seeing in the markets today? Give me sort of the macro view on what's going on.
There's a lot going on. I mean, there's talk of potential stimulus, and then there's the Chinese consulate in Houston, which is a little controversial. It's causing some issues. Just all kinds of stuff going on, and the markets don't really know how to react right now. It's a little bit up and down, a little bit mixed overall.
Do you think we can make it through this whole recording without saying the T word?
The T word.
We'll see. All right, let's get into, so we're going to talk about your top stocks, but first I want to address some questions. So I have a question from the WeTrade HQ community. It's earnings season, so we're in the thick of earnings. Why does a stock that beats earnings still go down? So that was a question, is like, you have a stock that beats earnings, you would expect it to go up. Why would it go down?
So one of the biggest misconceptions is that, because companies or stocks will beat earnings means that it automatically goes up. And it's a complete myth. And the reason being is because there's so many other factors that go into why somebody would buy into earnings or buy after, a decent report. And it could be, maybe they beat earnings, but revenue was down, or maybe they beat earnings, but growth was down. And so the stock market's always a forward-looking vessel. So when people see, or investors see that, okay, they beat earnings, but their outlook may not be good, then I don't want to be in it moving forward, because if they are telling us that, the company's not going to do well in this coming quarter, then, the value, it gets diminished at that point. So that's one of the biggest reasons as to why it would go down, even though earnings are good.
Well, and as of this recording, Netflix had their earnings last week. And I know leading up to earnings in your mentorship, your morning mentorship, you had said for Netflix, they couldn't just meet earnings. They needed to really crush earnings, which they didn't.
Right.
And so talk about that a little bit.
Yeah. So they actually missed earnings, right?
Yeah.
Yeah. They missed earnings, but everything else was good.
Mm-hmm.
So they missed the expectations on earnings, but the expected subscriber rate was down. And one of my biggest theories to any of that, or all of that, that really wasn't all mentioned, that I think Netflix may have a tough time with, is that, their original content.
Mm-hmm.
That's one of their biggest revenue drivers, or biggest reasons people come to their platform, is because of Netflix original content, and nobody's recording, right now. So I think moving forward, it may be tough for Netflix to actually, gain subscribership and really kind of beat earnings in the next quarter, maybe even the quarter after that, depending on when they get back to recording their original content, which I think, in my opinion, probably leads, companies like Alphabet or Google, because they own YouTube. We're talking on YouTube right now. So YouTube doesn't stop. I'm still creating content, and there's still live streaming going on. And so I think that people may end up flocking to Google to try to get some sort of content that's original, that they don't have to watch repeats on all the time.
Okay, great. So my question to you is going to be, I want to understand how you make decisions on positions you hold leading into earnings. But before that, let's get into your top 3 stocks. Tell me what the 3 stocks on your watch list are for this week.
All right. So I had a hard time putting these in particular order, so I'm just going to go with them.
Okay.
But one of the ones I really like is Newell, NWL. It's Newell Rubbermaid. And one of the biggest reasons is because as it relates to outdoor living or outdoor recreational stuff, and the biggest brand that they own is Coleman. And so Coleman tents, Coleman outdoor equipment, they have Coleman grills, they have all kinds of stuff. And what we've seen is a trend in people buying up RVs and trying to go out camping, doing things that you can still remain socially distant on, but still go out and have a good time and go on vacation. People are dying to get out. And so there's so much pent up demand for that they're finding anything they can do to try to go out and at least have some fun in this crazy mess that we're in. So in my opinion, I think this is a really good opportunity because we're seeing Yeti that has already gone up past their pre-Rona highs, among others, and it seems as if Newell has lagged that a bit, and it's priced right now around $16-17 a share. I think if it gets up above 17.50, it should really start to get fun once people start realizing this fact, and so I really like that.
Okay.
Next is going to be Lululemon. Lululemon, they just acquired Mirror, which is kind of going to be a competitor of sorts to Peloton. And Peloton's also, obviously we saw that Peloton's trying to create a smaller, cheaper treadmill as well. The stationary work at home type of thing isn't going away. And I think that these two companies really stand to benefit. But I like Lulu a lot because they're just a bigger company. They're more established. It's not that I don't like Peloton because, the way that we're looking at it right now, if you want to buy a Peloton bike, it's going to be 8 to 10 weeks before you actually get one. So the demand there is obviously very real. But what I like about the collaboration between Lulu and Mirror is that they know each other. They knew each other going into this. The creator of the Mirror brand or the Mirror product used to work for Lulu. So I think it's just a really good marriage. It makes a lot of sense, and I think that they're going to continue to move up. They made some really great moves from the $300 spot, and I think that this probably ends up getting to about $350 before it's all said and done. Lastly, it's been interesting. These remote work stocks have been a little bit all over the place, but I still like Zoom.
I knew it. I knew it was coming.
It's one of those things that, like, every time there's positive news on the Rona where it comes to the vaccine, the thing dips, comes all the way back down to whatever support level. And right now it seems to be right around 250. I see an easy 25% move from 250 if it starts to dip back down there. And I think we see 300 before the end of the summer. They're just crushing it in every facet. We just talked about this, right? We talked about how they're getting into the phone call things. They're just adding tons of features. Zoom is to video conferencing as Netflix is to streaming. They're going to have competitors. They're going to, have to fight their way to gain more market share, but they are it. Just like Netflix is still king, Zoom is quickly risen to the top of this thing. And I don't think remote work is going away anytime soon. I think it's here to stay. I think Zoom stands to benefit the most out of anybody.
I love Zoom, and I just think they're so far ahead of their nearest competitor that they, I love what they're doing. Obviously, they're making their brand better and they're making their sort of core competency better. Yep. But because they have this lead, they're now being able to enter into like the hardware monitor space. They're allowed to, they can do the voice over IP, which is just value adding. And I'm interested to see of where this thing is a year from now when we're now in our new normal.
Yeah.
And I think they're going to be a monster.
We're talking about them going up against companies like Facebook, Microsoft, Google, and they're crushing all of them. And I've heard a lot of arguments that, they have really stiff competition, but honestly, all those other platforms, it's not easy to use. Every time I talk to somebody that has to use it for work or whatever, they hate it and they would much rather use Zoom. So I think it comes down to the ease of use, obviously, and they don't have the prettiest looking platform, but it's just easy to use. And I think it's what most people care about the most. And the more that they add features and stuff like that, I think it's just going to continue to just keep on rocking, man.
Awesome. So, what I want you to talk about your decision-making process when you're holding a position leading into earnings and how you think about that and how you typically play those positions.
Yeah. So I think one thing that everybody should probably understand is that if you're going to hold in through earnings and you're going to buy a stock specifically because you think earnings are going to do well, the stock's going to go up, then you're pretty much gambling at that point because you really just have no idea where it's going. So for me, if I'm holding something and I plan on holding it through earnings, I'm usually going to trim some of that off. I'm going to try to minimize my risk. So I'll at least probably sell half my position, maybe even 75%, depending on how uncertain I am about how earnings may go. And then, there's always that opportunity to get in after earnings, because even if earnings do well and the stock blows up, there's always going to be some sort of pullback you can grab in on. There's no shame in averaging up, and honestly, I would encourage averaging up more so than I would averaging down. So I think that that's always the best way to do it. To hedge yourself and protect your risk is always to like make sure that if you're going to hold into earnings, knowing that there's just that risk that it may not go your way. For me, it's kind of like either I'm going to go get a scratch off or a lottery ticket, or I'll just play earnings. So I think the odds are better in my better favor when it comes to earnings than that. So I'll just, go that route. And, like I said, not holding anything that I couldn't afford to lose, and waiting to see what happens after they come out.
Okay. So bonus question. If we have a massive pullback on a stock and we have some big hitters that have been moving, which would you recommend the top one to really jump in on and take advantage of a big pullback?
Like what specific stock?
Yeah, give me a stock that you could see, because you're saying it's a coin flip. So which one?
Amazon.
All right.
I mean, look, even if Amazon doesn't do well, which I don't know how they would, but if it dips, then it's a no-brainer. And honestly, any good company that ends up beating earnings, but maybe just didn't get enough love from the market would also be a good candidate. Snapchat, I think, is a good one, good example of that they beat earnings, and they beat them handily. But couple of numbers that they were off by, and people just kind of crapped on it. I'm like, are you kidding me? So I think it's a gift on Snapchat.
Right. We made it through without saying the T word, Tesla.
I know. I was thinking Tesla or Trump, one of the two.
Oh, man. I love it. All right. So, fam, go visit Brad on his YouTube channel, Own the Chaos, where he really specializes in stocks to pick, what's going on in the news in the market. And he actually has a daily watch list, which you can join his membership on Own the Chaos.
We're almost 500 strong.
Yes, sir. And live every Sunday, 8 p.m. Eastern time, Stock Watch Sunday, where he talks about what's going on in the market. And don't forget to visit WeTradeHQ.com. Thank you, guys. And thank you, Brad.
See ya.